Welcome to FinFactor. I'm your host, Blaine Bertsch, co-founder and CEO at DryRun Cash Flow Forecasting Software, where we help the office of the CFO leave spreadsheets behind and model everything from cash flow through to complex scenarios with clarity and control. And joining me today is Matt Middendorp of Vision Point Capital, a company whose mission is to create the most successful employee stock ownership plans in the country. And today we'll explore everything ESOP, what works, what doesn't, and why it might be a right fit for your business. Welcome to the show, Matt.
No, thank you so much, Blaine, for having me. I really appreciate it.
So even a little intro here, I basically alluded to the fact is you want to make these successful ESOP plans,
Mhm.
across
Yep.
the country. I want to dive in right away. Like, what makes a successful plan? And then we're going to start to dive into what makes an unsuccessful plan as well.
No, I think those are two great directions to take this conversation. So I appreciate starting there. Um, a successful ESOP or successful transaction as we move into ESOP, really, it does three different things. Number one, it makes sure that the business owners or the sellers get a fair return, right? We find that a lot of our clients actually get a return that's greater than or equal to private equity, for example. So it's one of those deals where a lot of people think, hey, if I'm selling to my employees, I've got to sacrifice, I'm not going to make as much. Absolutely not true when you look at the after-tax returns on an ESOP transaction. So that's a win for the seller, right? But in my mind, the company also needs to win too. And it's not just good enough for the seller to sell. And the people that I'm working with, the people that are selling their companies are thinking about legacy, right? They're thinking about their employees. They're thinking about control. And they want to make sure that the people who are running the company today are actually still the people running the company. So is the company better off means financially, right? From a
Mhm.
cash flow perspective. And the tax incentives and the perks that come with being an employee owned company are fantastic. I'm going to just tease that right now. We'll come back to that later. That'll be
Right.
the pull over and by the side of the road and just kind of wait moment that we're going to have. But we want to make sure that the company's better off because they're more profitable. ESOP companies tend to grow faster than non-ESOP companies. Their productivity is better, especially in the first year after they become an ESOP. They get a better return on their assets, on their investments. So uh, we want that to happen. That's a very
Mhm.
important part of the process we work through. But then the employees also need to be better off too, right? The average
Yep.
ESOP employee has a 92% greater median household wealth than a non-ESOP employee. Well, shoot,
Mhm.
how do we make sure that that happens in a way that the company stays strong, the employees stay strong to make sure that key employees are taken care of, that they're excited about this too, and they see a return outside of the ESOP as well. So if the seller is better off and has a win through the process, if the company wins through the process and is better off, and the employees win through the process and they're better off, that is the win-win-win we're looking for. And that's what makes a successful ESOP.
So, there's some things you alluded to there that I think were really interesting, like, increase in productivity and like there's benefits to both sides. I'm sure
Yep.
there's engagement from the employees as well. Um,
Well, let's just be
is
honest,
are
Blaine. Where else
Sure.
do you get where the financial growth of the company is directly tied to the financial growth of the employees? I mean, those two things
Yeah.
are going to be aligned for the first time in an ESOP. So,
Yeah, and I
yep.
think like now, we've heard mostly since, last number of years, this term quiet quit came out of nowhere. And there's
Yeah.
things like that where obviously there's in some areas, there's a lack of engagement from employees. And so this might be, maybe more critical than ever to make sure that you're really engaging those employees.
Yeah, absolutely. And typically, an ESOP employee stays with the company 4 to 5 times longer than if
And
they
we all
work for a
know how,
non-ESOP company.
yeah, and we know how expensive and difficult it is to replace employees. Is such a challenge to find the right people to go through all the training again. Very, very costly. Um, have you seen like are there times where you would say, probably doesn't work for your company? Or are there times where it just isn't a fit or maybe detrimental in some way?
Yeah. So that's a great question. And here's what I'll say is number one, my job is education, right? And the first thing I always ask when I'm working with somebody who's exploring ESOP and they're just kind of curious about it is, what are your goals? Because you want to make sure that what they're trying to accomplish matches up with the outcomes that happen in ESOP. If you're looking to sell your business and just walk away and be done, ESOP's probably not the right way to go, right?
Yeah.
If you are looking for um, let's just say, for example, you have a typical ESOP has a minimum of 15 to 20 employees, right? That's a guideline, not a rule, but that's one of the places we're going to start is 15 to 20 employees, yes or no. Then we got to start breaking it down if the answer is no. Um, they need to be US based, right? So I talk to companies all the time where they're not US based, but they've got a subsidiary in the US. Well, doesn't count. Um,
Hmm.
they need to be profitable. They need to be successful. I've already mentioned that ESOPs, you're not sacrificing your after-tax return by selling to an ESOP. Well, that's because an ESOP company still has to be a sellable company. What
Yeah.
happens in an ESOP transaction is an ESOP trust is created, and that ESOP trust buys the company from the sellers. So the company is
Okay.
actually owned by this trust. Now, the perks of that, though, are there is a trustee that oversees the trust, but the trustee does not run the company day to day, right? They don't want to be involved day to day. The people running the company stay with the management of the company who's been put in place. So, so by going through this then, and by making sure that the company is sellable, you got to make sure the management team is clearly on board too.
Yeah. Can you walk through like just I there's a couple things I kind of want to explore here, and I'll let you
Yeah.
kind of pick the order. One is, what are where have you seen it go wrong, like in the actual setup or implementation or execution of it? And then also what is kind of the process of this is how you would actually set this up, and some just a bit of an overview of how that would work. I don't know which makes sense to tackle first.
No, those are both great. Um, I'll tell you what, let's talk about where ESOPs go wrong. We've talked about all the good, right? And I've dangled
Mhm.
tax benefits and both for the seller and the company, and employees stay longer. You're hiring and retaining better talent as an ESOP. But let's talk about where they go wrong. Number one, the main place where they go wrong is just quite simply the person who is helping you create this ESOP overvalues the company and creates a debt that the company can't afford,
Mhm.
right? The company has to pay the seller. And if the company can't afford that debt, that can cause a real hardship on the company. So, what you want to make sure you do is that great ESOPs are made by great process, right? And you just asked about the process. We'll dig into that in a
Mhm.
second. But you want to make sure that that's done well and done right because it's not just about your return, it's about making sure the company is better off. You shouldn't have to sacrifice for one for the other. But if the return you're expecting, again, my job is to manage expectations and educate. If the return you're expecting does not benefit the company, then it's probably not something you should do. But that isn't always the advice that people get or always the direction they take.
Yeah.
Um, so that is definitely one place where I see ESOPs that go bad is right from the start. They're overvalued and the company can't afford it. Fortunately, again, the process should uncover that before you get that far.
Mhm.
The other place that I see ESOPs that tend to be a problem is, I'm just going to be honest, any local accountant, any local attorney can create an ESOP,
Mhm.
but that doesn't mean they know how to set one up that's successful. So the company I work for quite often has to fix the ESOPs that are set up wrong by other people. And
Yeah.
one of the things that I see is the shares go out too fast, right? Now, the shareholders in the company through an ESOP, the employees are beneficiary shareholders, right? They're not directly, they don't get voting power. They don't get to change the name or hire and fire people. They are beneficiary shareholders.
Mhm.
But it's one of those things where those shares typically will go out over 30 years, for example. And if you set it up wrong and all the shares go out over 5 years, well, what if people start cashing in those shares, right?
Mhm.
What if people start leaving or retiring and all the shares are out? Well, gosh darn it, that means you got to pay those people. And that can create a financial hardship for the company.
Mhm.
So, like I said, typically when we create an ESOP, it's going to be a million plus shares. They're going to go out over 30 years. There's a vesting period involved, but you got to make sure that you're setting yourself up for success there and understand how those things affect the process. And again, there's a place where all of those things are laid bare if the process is done correctly. And then lastly, the thing that I get asked about the most is the repurchase obligation, meaning later on, right?
Mhm.
7, 10, 15, 20 years from now, how do you know your company can afford to pay back those shares that are out as the share price has gone up? People may have a million, million and a half, $2 million in their account and they start retiring. How do you know you can pay them? Again, through the process, you're going to have a plan for doing that, both in the beginning, but your trustee and honestly probably your bank are going to require you to study and model that repurchase obligation. So you're going to be preparing for it over time. So the only way
Mhm.
you get in trouble there is if you don't pay attention to it, right? If you look up one day and say, "Oh, it's been 10 years. I wonder if people are going to start cashing these in." Fortunately, like I said, there's stops in place where that isn't the case. But again, I've seen it where companies have had to kind of fix some things on the back end because we're the place they go to get those things done.
So can you, yeah, and if you could actually describe a little bit of how this works and the
Yeah,
different options, I guess, because a lot of things you started to allude to are some of the things I'm curious about is like, what is a typical vesting period? And what, like, if
uh-huh,
someone just walks and they go, now you owe me a bunch of money, how does that work? How,
yep,
like, I'm just curious yeah, especially when you're talking about a company that, might be 15, 20 people to start with. A lot of times there's not a whole lot of money moving through a business like that. And they,
yep,
especially a time like this where cash flow, we hear companies every day are talking about cash flow today, right? And
yep,
so that's the first thing my ears perk up a bit. Someone leaves and all of a sudden there's a big check that's going out the door as well, right?
yep. Well, there's a lot of uncertainty in the economy right now. That is for sure. So I hear that conversation every day. Here's where the process mitigates some of these things, right? So I gave you some key points just a minute ago about maybe you paid too much for the company, maybe the shares went up too fast. How do we mitigate those things? And that's done through the process of creating the ESOP. So you asked about that a minute ago. Step one is education, right? Talking to people like me, watching videos, attending events through the National Center for Employee Ownership, stuff like that. Um, at the end of that education phase, I call it the I think I want to phase, is something called a feasibility study. And this is the first place where you put a little bit more than just time into it, where you make a small investment to get data,
Mhm.
right? So we actually model out and we give you a value of your company through a feasibility study. We give you the company outlook for an ESOP for 10 based on a 10-year forecast, right? So we can tell you cash flow, we can tell you the tax benefits of an ESOP and how they affect your company. um, we can show you what it costs to pay back the sellers and how that looks if you do it through a bank. We talk about options. If you do it through the bank, if you do seller financing, like all these, if you sell 30% versus 100%, we can model all that out through this feasibility study. And then through that study, we also show you the impact on the employees as well and the balances they're going to carry based on those projections. Now, here's what's really cool about that is it's a just by its very design, a decision making tool. The goal of the feasibility study is to lay a value in front of you and allow you to say, what if, right? What if we sell 30%? What if we sell 100? What if we sell, what if we do bank financing? What if we don't do bank financing? What if we do something called the 1042 exchange, which gives tax benefits to the sellers? All these things come together so the seller sees their return. The company knows if it's okay based on the amount that we project the company will sell for. And honestly, the thing that the sellers I talk to get most excited about is how are they changing the lives of their employees with this wealth that they're
Mhm.
helping them create that they wouldn't otherwise have? So that's where a really, really good process helps you make something that allows you to say, yes, ESOP makes a ton of sense, or no, I think I've got to look at other exit routes.
And how is the valuation kind of, sorry, I may have
No, this is
jumped a
good.
little too soon
No,
here,
do it,
but
do it, do it,
I'm kind
jump
of,
in.
yeah, I'm curious how the valuation, like, when you're looking at it and going like, yeah, we're looking over 10 years and here's what's going to happen. So, yeah, then
Yep,
COVID hits, right? And also you're
yep,
like, no, valuation is, we saw companies, their valuation is like retail. Doors shut,
mhm,
valuate, like there were companies that were valued and I was listening to a podcast today of a company that was about to exit for like billions of dollars, and also they're like, you're going to go into bankruptcy, and it was just like that, and it was left and right and trying to survive. The valuation goes up and down. How was that managed and sort of actually measured moving forward, so that if someone leaves and says, "Well, I want to take my money with me now," oh yeah, here's where we are today, right?
mhm. So that's a great question. And obviously, the sale price is the sale price. When that's agreed upon and the transaction closes, that's what the seller gets paid, right?
Okay, yeah.
Plus, again, if seller financing is involved, plus interest. Interest is typically 1% or 1.5% above the going rate. So there's a premium as the seller for taking on that risk if you do seller financing. So, but you're right, the company still has to pay back the seller. The company still has to pay off these other obligations. And there are ways to do that to soften the blow. So let me just tell you a quick story about a company that I worked with during COVID. It was a restaurant. And we all know what happened to restaurants during COVID is it was basically
Mm.
carry out only, and they were just trying to survive.
Yep.
Well, one of the really neat parts about this is this person did seller financing and they're the bank, right? So during that time, they recognized that it was an unusual situation that was going to probably have a shorter term effect.
Mhm.
And they decided to do interest only for 6 months. And by doing interest only payments to them for 6 months, they didn't sacrifice any of their return. Over the long term, they recognized that they were putting their company in the right place to be successful during this extraordinary event. And then in 6 months, they started their regular principal and interest payments again, but they gave the company the cushion they needed to get through that difficult time. So that's one of the really cool parts about ESOP is, again, I want to stress you stay in control. Now,
Mhm.
there are some caveats, right? There's some governance things. There's a board that needs to happen that oversees some strategic direction. But guess what? The seller is part of the board, right? The seller is helping to make those strategic decisions. So it's not like it's a board that's imposed upon them. It's a board they choose.
Mhm.
So as you're going through that process, then you have that flexibility to do that. Now, when it comes to repurchase obligation later, if somebody is retiring and it's a tough time for the company, right? There are ways to stretch that out that are usually part of an ESOP plan, right? The actual plan
Okay.
document itself, you lay out the parameters. So you may pay them out over 5 years, for example, right?
Yeah.
Vesting is involved. And this is really cool part about ESOP is it's subject to the same rules as your 401k. So it's under the same law. It's called ERISA. And it was established in the 70s. And there's a vesting period, a 6-year graduated vesting period that a lot of companies go with. And that allows you to not have that build up too quickly. Right. So people
Mm.
aren't going to have balances right away. You're not going to have to deal with that right away. You probably won't have anything significant from a balance standpoint for 10 to 12 years before you really have to worry about those options. But again, you've got the opportunity to stretch out those payments for larger balances. So it's not all on at once. You don't just have to shell out $1 million one day.
Yeah.
You pay that out over time.
So it's like the devil's in the details. Like,
Yeah.
which is why they would need someone like you. I wouldn't probably not like, hey, chat, can you make an ESOP for me? No, you probably
I
want
don't
to
know.
make sure
I've,
that,
I've, I've tried. It actually does okay. No, I'm just kidding. But you're right. It's about well, and again, I want to come back to this idea. It's about your goals, right? It's about the goals of the seller and the goals of the company.
and I think this
Yeah.
this reminds me of my previous business. We did a lot of government work
Yeah.
and enterprise work and things like that, and we would get these boilerplate contracts in the door, and my lawyer could go through the contract and explain what I could probably also see in the contract. Where the disconnect was how do some of the points in that contract affect our business? And that was the things that I was always looking at is that the lawyer wouldn't necessarily pick up that might really hurt our cash flow if
Hmm.
A or B happens, right? And so I would go back and I would be able to negotiate on something that nobody who made the contract cares about. But from a business perspective, these details matter. And I think
Yeah.
that's
Well, the same
what I'm
thing with
kind of
loan
hearing here.
covenants, right?
Yeah.
Same thing with loan covenants when you're borrowing money. Those details matter more than just the money you're borrowing. That's absolutely correct. It's about
Yeah.
process.
Yeah.
Great ESOPs are made through great processes.
Yeah. Yeah. So tell me a little bit about like what you do, how you engage with customers, who should be coming to talk with you about this if
Mhm.
they're considering an ESOP for their business.
Yeah, no, I think that people who should be talking to me are people who are thinking about what's next. And I want to be clear about ESOP. It's not just about exiting the business. It's also about leveling up the business. And if you don't mind, I'll just give you a brief example of what that sounds like. I worked with a company. They're actually a construction company. And the owners, there was 4 different owners. They're in their 40s.
Mm.
And they were trying to figure out what they wanted to do to pull some liquidity out of their business because they had other interests and other things they wanted to do, but they didn't want to stress this thing that they built. Listen, I
Mhm.
sold a business, and let me tell you, it is the single hardest decision I ever made getting married, having kids, going to college. I mean, all those things were child's play compared to the nights that I spent laying awake going, I got this offer on the table. Is this something I want to do? Right. And they were in that same place. So they watched some videos, they talked to some M&A people, they looked around, then they finally talked to their accountant and said, are you familiar with the tax benefits of an ESOP for your company? And they said, no, what are they? Well, she said, you're an S Corp. And they went, yep, we've been an S Corp the whole time. Well, guess what? If you're 100% employee owned as an S Corp, you no longer pay state or federal income taxes for your business. So the K1s that would normally go to the shareholders for a S Corp now go to the ESOP, and the ESOP does not owe tax on it.
Wow.
Yeah. Should I have warned people? Should they have had to pull over? Is there cars swerving on the highway right now from the shock of that? Right. So, and it's proportional, right? So if you sell 30% of the company, you get 30% of the benefit. So depending on how much you decide to sell, what your company can afford from a cash flow standpoint, all of those things determines that benefit. And that's part of that feasibility modeling that we talked about earlier, that study that we do. Now, they decided to sell 100% of the company with the 4 owners to their ESOP. So now they're an employee-owned company, but they still work there every day. They're still the CEO, the CFO, all those things that they did before, they're still doing. They're actually earning shares, by the way, because they work there inside of the ESOP, in addition to getting paid as the sellers. And for them, that made sense. Their company is more productive. And guess what? Now, when you call them, the people at the front desk, and we know what it's like being business owners, we get calls from potential vendors trying to sell us stuff all day, every day. Now, when those employees pick up the phone, they say, hey, I'd like to talk to the owner. They all say, you're speaking with them, which is kind of cool. So everybody wins. Everybody wins.
Yeah.
So the people that should call me are the people that are thinking about what's next for their business. They're looking for a way to gain a competitive edge. They're looking to hire and retain better talent. They may be thinking about exiting their business and they don't want to sell to private equity because they know that the profits that they make now that stay in town and put the scoreboard on the local football field or fun art in the park or whatever that is, they don't want those profits to go out of town, right? They don't want PE to buy their company and take it apart in 3 to 5 years and watch it leave. In a lot of communities I work with, I'm in Wisconsin, right? So rural Wisconsin community, if a manufacturer leaves town, that town is never going to get it back. So if you're thinking about your legacy, if you're thinking about what's next and you want to stay in control through the process and you want the company better off and your employees to win, then we should talk and we should see if what you're trying to accomplish lines up with what an ESOP does.
Yeah. And how should they get hold of you? What's your web address? Like, how should they track you down?
So there's a couple of different ways to do that. I'm going to give you a great website that you can go to. It's ESOP Ready, ESOP Ready.com. On that website is a ton of information, but you can also actually take a free assessment that'll give you an ESOP Ready score. And then you can actually schedule time with me right through there too, if you'd like. So it's a really neat tool to go in and do some research and learn about employee ownership from an ESOP perspective and just see where you're at. I'm just gonna throw, if you don't mind, my cell phone out there too, Blaine. I'm gonna put this on the internet. Give me a call directly, Matt Middendorp. You can reach me at 715-897-0879. Again, my job is education. My job is to help people understand what this is about. And the thing to remember is you don't have to say yes or no, is an ESOP right for you? You need to learn about it and decide if you want to study it. And then you can make a decision.
Yeah, no, that's I've learned a lot today from you, Matt. This has been amazing, and just that last story was really helped to sort of pull it all together to wrap my head around it. So this has been really valuable. And
thank you.
Yeah, so if I'll drop that website address in the show notes below and your number so that people can phone you and get a hold of you. Thanks a lot, Matt. This was really terrific. Great information.
No, you asked some great questions, Blaine. I can see why you're one of the best out there. This has been a lot of fun. Thanks for having me on.
Thanks so much. And if you're a CFO out there and you guys are buried in spreadsheets, you and your team are in there half of your week trying to figure out what's happening in your cash flow, where your business is headed, what your revenue looks like, come and talk with us at dryrun.com. We'll get you out of those spreadsheets and get you in the management meetings by Monday afternoon, not Friday afternoon. So thanks again, Matt. Appreciate it.